So in the previous videos, we were looking at us as the purchaser of inventory. So we were bringing in all of that inventory to get it ready to sell. And now we are going to look at us as the seller. So now we're selling the inventory and we're recording the related cost of goods sold. And again, this is still under the perpetual method. And a quick reminder about the perpetual method, we are continually updating our inventory. So the inventory balance in the account is always updated. So all of our purchases went through there. Even if we got a discount or returned or had an allowance, we updated the inventory account. So now we're looking at us, the seller. So when we sell inventory, there are always two, at least, journal entries that need to be recorded under the perpetual system. So the first entry will be recording the sales revenue. So we have delivered these goods, we actually have done the work, we've earned this revenue, so we will record the sales revenue and then either cash or accounts receivable, depending if it's on account or not. So we book that revenue. But now the second entry is to record the cost of goods sold. So we've given the inventory, we've delivered that, sold those goods. We no longer have that as an asset, and therefore it now becomes an expense. So we need to take those items and the cost, take it out of inventory and move it into cost of goods sold, which is an expense account. So this goes back to the matching principle that we discussed earlier. We need to match the costs with the revenues. So the reason we were able to earn these revenues was because we had this inventory that was sold. So we match those up. So I say at the top here we have two entries at least, and there could be other costs related to the sale. So for example, freight out. If we also have to pay to ship this inventory to somebody, that would be another cost. And this would just be recorded in a separate journal entry. Okay, so let's look at an example. So we are now the seller. So we're selling inventory. Seller Incorporated has $60,000 of inventory on hand. On July 9th, Sellers Inc., and that is us, we are seller. They have a great day and have sales on account of $10,000. And the cost of the goods that were sold is $6,000. So the journal entries to record the sale and update inventory are as follows. So the two entries, we're recording revenue and we're also recording the cost of goods sold. So for revenue, we now use a new revenue account because we're selling goods. So it's no longer service revenue, but now we will credit sales revenue because we have sales of goods. And we sold this for $10,000. And it says that the sale was on account, so that goes into accounts receivable. We're still waiting to collect this amount. So that's the first part. The second part of this entry is now that we've sold this inventory, we need to move it out of inventory and into cost of goods sold. So cost of goods sold is an expense. To increase that, we will debit it. So we'll debit cost of goods sold, and we're moving it out of inventory, so we need to decrease the inventory account, so we will credit that. And the cost of the goods sold were $6,000, so that is the amount that goes in this second part of the entry. So we obviously want to have sales revenue higher than what it cost us. And that is the gross margin. So on this sale, we have a $4,000 gross margin, which is our sales revenue minus the cost of goods sold. So you obviously want to sell for more than it cost you. That is how you make money. So we would say here to record sale and cost of goods sold, something like that. Or if we did it as 2 entries, to record cost of goods sold, and up here we would say to record sales revenue. Since this is the perpetual method, we're always updating inventory, and that is why we need this second entry. We want to know that we've got rid of this $6,000 of goods, so we move it out of the inventory count into cost of goods sold. Okay, so that's the sales side. There's these 2 entries. But after a sale, there's more things that could go on, just like we saw after a purchase. So the seller may experience a sales return. And again, this is where the customer is returning the goods for a full, it says discount. Oops. This should say refund, a full refund. So just like us, the purchaser, we could return something. Now that we're the seller, our customers may return something to us, and we grant them a refund. A sales allowance is now the seller granting an allowance to reduce the original sales price. So maybe there was an error, a defect, some minor damage. So our customer now, they've decided to keep the inventory, but we are giving them this reduction in price. So we record this adjustment for the reduced amount that we will collect. There could also be a sales discount. So now if our customer pays within the discount period that we offer, we will be collecting this discounted or reduced amount. So these are the terms that you would see on this side as well. So for sales returns, allowances, and discounts, the idea is exactly the same on the purchase side, only now we are representing the seller. So we're the other side. We're going to be collecting less money for these reasons. Now the other item that we might see that we've discussed a little bit is freight out. So again, freight out is because we are shipping something out after we've sold it. So if the seller has to pay these costs, then it must be freight on board destination. Because in this case, the seller owns during transportation until it reaches the destination, and therefore the seller pays. So now we're the seller, therefore we would have this freight out cost if it was freight on board destination. And I want to note here, just a reminder, that freight out is an expense. Freight in was part of the cost of getting the inventory ready to sell. So we added that into the inventory account. But freight out is after it was ready. So it is an expense account. So you would actually debit an account called freight out. So when we are recording sales discounts and sales returns and allowances, these are recorded not just against the sales revenue account, but we actually create separate contra accounts to sales revenue. So remember, we talked about contra accounts with amortization. And we said a contra account is an account that is linked with another account. So in this case, these accounts are linked with sales revenue. And they're shown together on the financial statement to decrease that amount. But because they're so important, we want to track these separately. Just like we did accumulated amortization, we're going to track sales discounts and sales returns and allowances in separate accounts. So the way that we would see this to calculate net sales is you would have your sales revenue. So this is the amount that's booked at the time the sale actually occurs. And then it would be reduced by the contra accounts, which are sales discounts. And then we combine sales returns and allowances into one account. So you subtract each of those, and that gets you to net sales revenue. So in terms of the normal balance of these accounts, because remember also that a contra account has the opposite balance of the account that it's linked with. So when we record revenues, including sales revenue, we know that the normal balance is a credit. So sales revenue would have a credit balance. When we have a discount or return or allowance, we would be debiting these accounts. So these two accounts would have a normal debit balance, which is shown to reduce this gross amount in sales revenue. And therefore, in the end, we would still end up with a credit. It would just be a smaller amount. So why does this need to be done? Why do we record these discounts, returns, and allowances in a contra account? And the answer, as always, is it's for the users. So it's really important for management to be able to track any returns and allowances and discounts that go on. So they would want to know, if we talk about discounts first, how much money are they losing from offering these discounts? So if they track this in their own account, after several months or the year, they can look and see how much money they actually lost or how much cash they collected less of because they offered these discounts. Now, if it ends up getting too high, maybe they decide that they want to reduce the discount percentage that they offer, or reduce or eliminate this discount at all. So they need to know how much this discount is so they can make those decisions. When it comes to returns and allowances, again, management wants to look at how many people are returning goods and why are they returning them. So if this balance in returns and allowances is getting too high, they would investigate that. So if people are looking for an allowance or return because there was damages to goods, that tells the management that either if they're producing goods, they need to fix up their production process to make sure there's no more damages. Or maybe there was damage in shipping, so they need to hire a new shipping company. Or perhaps they were just sending out the wrong goods, so people were returning them because they got the wrong item. Well, now that tells management we have some sort of issue that we need to work through in our shipping department. Why are they sending out the wrong goods? So tracking these accounts as contra accounts is just important so the users have that type of information available. Okay, so let's continue the example that we started earlier. So here on July 9th, seller, they made these sales for $10,000 revenue and the goods cost $6,000. So let's just move over a little bit here. So we already booked this in our previous example where we were looking at the sale. Now we're going to continue on with this. And on July 12th, the customer returns goods to seller for $3,000, and their returned goods had a cost to seller, which is us, of $1,800. So we're going to say we're issuing what's called a credit memo. So we give this invoice to the customer that shows them, okay, we got those goods back and now you owe us less money. And when you do this as a journal entry, it looks as such. So July 12th. So first off, they're returning us goods that that have this value, a selling price of $3,000. So they've returned them to us. So here we're going to record that return. But as I said, we're not going to use the sales revenue account. We use this new contra account. So we debit sales returns and allowances. And it's the $3,000 amount because that was the selling price. And since this customer's returned these goods, they're no longer going to pay them for us. So we also need to reduce our accounts receivable. So we credit accounts receivable to reduce it by $3,000. So that's the first part. But like when we sold the goods, we also have to consider the inventory and cost of goods sold side. So here it is a return. The customer is actually giving us these items back. Because of that, we also need to reverse the entry and put the items back into inventory. So we will debit inventory because we got these items back. So debit $1,800 and credit our cost of goods sold. These goods are no longer sold since they've been returned to us. So we also want to decrease that. To record return of items or inventory, something like that. So when it comes to a return, a sales return, we have both the entries because we got those goods back. Okay, next part, we're assuming that on July 15th, seller, so us, we granted a $500 allowance for damaged goods. So now remember, with an allowance, the customer keeps the items, but because there was this damage, we give them the reduction in price. So July 15th. Again, we're granting this allowance, but we want to track it in a separate account. So we will debit sales returns and allowances again. Put both returns and allowances into the same account. And since we've given them this reduction, we also credit accounts receivable. This customer will never need to pay us this $500 reduction. So we want to take it out of the amount that we say we still have left to receive. To record allowance. Now here, they kept the inventory. We did not get these goods back, and therefore we only have the one entry because no goods received back, so we don't need to put anything back into inventory. So only the one entry when it comes to an allowance. With the returns, because we got something back, we put it back into inventory. An allowance, we didn't get anything back. So only reduce the revenue through the contra account and reduce the accounts receivable. So updated accounts receivable after all of this. Well, the original sale happened on July 9th. And on that day, we recorded $10,000 to AR. Then on the 12th, we had a return for $3,000, so we decreased AR by that much. And above, on July 15th, we granted an allowance for some sort of damage. So that also decreased our AR. So after all of these transactions, we have this $6,500 that we are still due to collect. Okay, so now finally we end up having the customer pay this invoice on July 29th. So on the 9th, when we made the original sale, the terms were 2/15 net 30. So now again, whenever we offer some sort of credit terms, first question is, did we now collect this money within the discount period? And therefore, do we have to give a discount to the customer? So if on July 9th, they bought this and they had 15 days, they really did have until the 24th. So we're here on the 23rd. That means, yes, this customer did pay within the discount period. So yes, in discount period. So we are ending up that we're going to collect a discounted amount from the customer. So we need to know first, what is the balance that's still owing? And we calculated that on the previous slide. This customer still owed us $6,500. So that is the amount where we calculate the discount. And this 2 here represents 2%. So we do the math and we end up with a $130 discount. So the entry side, the idea here with a sales discount is the same as when we had a purchase discount. But now we're on the seller side. So we know 2 things for sure. One, we're collecting cash because the customer is paying us. So like we always do when we collect on account, we will debit cash and credit AR. So the AR, the balance that was still outstanding was $6,500. We need to get rid of that full amount. So we're going to credit AR for $6,500. But for cash, we know we're not going to collect the full amount because they received this discount. So the only cash we're going to get is $6,500 minus the $130 discount, which is $6,370. So we need our debits to equal our credits. So we still need a debit here. And we know it goes into this new contra account. So the amount that we're actually earning, is getting reduced. So we debit sales discounts for the $130. And this is the contra revenue account. So that would be shown as a reduction to our sales revenue to get to the net amount. So we would say to record collection in discount period. Okay, well that is a look at how we do that. Now if we quickly here just calculate our net sales, so we know we start with the sales revenue amount. We look back to the original sale, we see that here. We had the credit to sales revenue of $10,000. That was the original amount that was sold. This would be $10,000. But then we also had sales, and just because I ran out of space, I'm just going to put RNA. So sales returns and allowances. So we know the first thing we had was this return of $3,000. And then we also granted an allowance of $500. So overall, we have a $3,500 sales return and allowance. And then finally, this customer paid within the discount period. So we also would have a balance in the sales discount account for $130. So our net sales, you do the math there, 10,000 minus 3,500 minus 130 gets us to 6,370. And again, this is equal to the cash that we collected that we can see above. So that was the amount here. So our net sales is equal to that cash that we ended up collecting on this group of transactions related to this one purchase. Okay, so now that we've gone through one, I want you to practice on your own as well. So below the video, I will have a question for you to practice on your own.